Hi, in this video we will be talking about navigating the stock market. Watch this video to the end to learn what you need to know to maximize your gains. Welcome back to the International CEO. The stock market is a dynamic and ever-changing arena where investors can potentially grow their wealth. However, navigating this complex landscape requires knowledge, strategy, and discipline. In this comprehensive guide, we will explore essential principles and strategies to help you maximize your gains in the stock market. Understanding the basics. Before delving into advanced strategies, it's crucial to grasp the fundamentals of the stock market. Stocks represent ownership stakes in publicly traded companies. When you buy a stock, you become a shareholder and participate in the company's growth and profits. Stock prices fluctuate based on various factors, including company performance, economic conditions, and investor sentiment. Key concepts. Risk and return. One of the fundamental principles of investing is the relationship between risk and return. Generally, higher returns come with higher levels of risk. Understanding your risk tolerance is essential for building a balanced investment portfolio. Diversification. Diversifying your investment portfolio is a crucial strategy for managing risk. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the impact of any single investment's performance on your overall portfolio. Market research. Conducting thorough research is essential before making any investment decisions. Analyze company financials, industry trends, and market conditions to identify potential investment opportunities. Utilize various sources of information, including financial news, analyst reports, and company filings. Investment strategies. Long-term investing. Long-term investing involves buying and holding stocks for an extended period, typically several years or more. This strategy aims to capitalize on the growth potential of quality companies over time. By focusing on fundamentals and ignoring short-term market fluctuations, long-term investors can ride out market volatility and potentially achieve significant returns. Value investing. Value investing involves identifying undervalued stocks trading below their intrinsic value. Value investors look for companies with strong fundamentals, stable earnings, and attractive valuations relative to their peers. Patience and discipline are essential for value investors, as it may take time for the market to recognize the true value of a stock. Growth investing. Growth investing focuses on investing in companies with the potential for above-average earnings growth. These companies are typically in fast-growing industries or have innovative business models. Growth investors are willing to pay a premium for stocks with high growth prospects, betting on future earnings growth to drive stock price appreciation. Dividend investing. Dividend investing involves buying stocks that pay regular dividends to shareholders. Dividend-paying stocks are often mature, stable companies with consistent cash flows. Dividend investors prioritize steady income streams and long-term wealth accumulation through dividend reinvestment. Technical analysis. Technical analysis involves analyzing historical price and volume data to identify patterns and trends in stock prices. Technical analysts use various tools and indicators, such as moving averages, support and resistance levels, and chart patterns, to make investment decisions. While technical analysis can provide valuable insights into short-term price movements, it's essential to combine it with fundamental analysis for a comprehensive investment approach. Risk management. Despite careful planning and research, investing always carries inherent risks. Here are some risk management strategies to help protect your investment portfolio. Asset allocation. Determine the optimal mix of asset classes, stocks, bonds, cash, etc., based on your investment goals, risk tolerance, and time horizon. Asset allocation allows you to diversify your portfolio and minimize risk exposure. Stop-loss orders. Implement stop-loss orders to limit potential losses on individual stock positions. A stop-loss order automatically sells a stock when it reaches a predetermined price, helping to prevent further losses in case of a significant downturn. Portfolio rebalancing. Regularly review and rebalance your investment portfolio to maintain your desired asset allocation. Rebalancing involves selling overperforming assets and buying underperforming assets to bring your portfolio back into alignment with your target allocation. Risk assessment. Continuously assess and monitor the risk level of your investment portfolio. Consider factors such as volatility, correlation, and concentration risk to ensure that your portfolio remains well diversified and aligned with your risk tolerance. Navigating the stock market can be a rewarding but challenging endeavor. By understanding the basics, implementing sound investment strategies, and practicing effective risk management, you can maximize your gains and achieve your financial goals. Remember to stay disciplined, stay informed, and remain patient, as successful investing often requires a long-term perspective. With the right knowledge and approach, you can navigate the complexities of the stock market and build a prosperous investment portfolio. In this continuation, we'll delve deeper into advanced strategies, explore the role of emotions in investing, discuss the impact of economic indicators on the stock market, and examine the influence of global events on investment decisions. Advanced strategies. Dollar cost averaging. Dollar cost averaging is a strategy where investors regularly invest a fixed amount of money into the stock market, regardless of market conditions. This approach helps smooth out market volatility by buying more shares when prices are low and fewer shares when prices are high. Over time, dollar cost averaging can result in lower average purchase prices and potentially higher returns. Contrarian investing. Contrarian investors go against the crowd by buying stocks that are out of favor with the market or selling short stocks that are overhyped. Contrarian investing relies on the belief that markets are often driven by emotions and that investor sentiment can be irrational in the short term. By taking a contrarian approach, investors can capitalize on market inefficiencies and potentially generate outsized returns. Options trading. Options trading involves buying and selling options contracts, which give investors the right to buy or sell a specific asset at a predetermined price within a specified period. Options can be used for speculation, hedging, or generating income. However, options trading can be complex and risky, requiring a solid understanding of options pricing, strategies, and market dynamics. Margin trading. Margin trading allows investors to borrow funds from their brokerage firm to buy stocks or other securities. While margin trading can amplify potential gains, it also magnifies losses and carries significant risks. Investors should be cautious when using margin and only do so if they fully understand the risks involved. Emotions in investing. Emotions play a significant role in investment decision-making, often leading to irrational behavior and poor outcomes. Common emotions that influence investors include fear, greed, euphoria, and panic. To mitigate the impact of emotions on investment decisions, investors should cultivate discipline, patience, and emotional intelligence. Developing a well-defined investment plan, sticking to a long-term strategy, and avoiding impulsive decisions can help investors stay focused and avoid emotional pitfalls. Impact of economic indicators. Economic indicators provide valuable insights into the health and direction of the economy, influencing investor sentiment and market trends. Key economic indicators include Gross Domestic Product, GDP. GDP measures the total value of goods and services produced within a country's borders. It serves as a broad indicator of economic growth and is closely monitored by investors for signs of expansion or contraction in the economy. Unemployment rate. The unemployment rate measures the percentage of the labor force that is unemployed and actively seeking employment. Rising unemployment can signal economic weakness, while falling unemployment may indicate strength. Consumer Price Index, CPI. The CPI measures changes in the prices of a basket of goods and services purchased by households. It is a key indicator of inflationary pressures in the economy and can influence monetary policy decisions by central banks. Interest rates. Central banks use interest rates to control the money supply and influence economic activity. Global events and investment decisions. Global events, such as geopolitical tensions, natural disasters, and health crises, can have significant implications for the stock market and investor sentiment. For example, political instability in a major oil-producing region could lead to supply disruptions and higher oil prices, affecting energy stocks and the broader market. Similarly, a global pandemic like the COVID-19 crisis can cause widespread market volatility and economic uncertainty, prompting investors to reassess their investment strategies and risk exposure. When navigating the stock market, it's essential to stay informed about global events and their potential impact on financial markets. While it's impossible to predict the outcome of every event, investors can prepare for various scenarios by maintaining a diversified portfolio, conducting thorough research, and staying vigilant for emerging risks and opportunities. In this final section, we'll explore additional considerations for investors, including the importance of continuous learning, the role of financial advisors, and the potential benefits of passive investing. Continuous learning. The stock market is a dynamic and evolving ecosystem influenced by a myriad of factors, including economic trends, technological advancements, and regulatory changes. To navigate this ever-changing landscape successfully, investors must commit to continuous learning and self-improvement. Staying informed about market developments, industry trends, and investment strategies is essential for making informed decisions and adapting to evolving market conditions. Fortunately, there are numerous resources available to help investors expand their knowledge and stay abreast of the latest developments in the financial world. Investors can leverage a variety of sources, including financial news outlets, investment websites, books, podcasts, and educational courses. Additionally, participating in investment forums, attending seminars, and networking with other investors can provide valuable insights and perspectives. By embracing a growth mindset and remaining open to new ideas and opportunities, investors can continuously enhance their investment skills and position themselves for long-term success in the stock market. Role of financial advisors. While self-directed investing is a viable option for many investors, others may benefit from the guidance and expertise of a professional financial advisor. Financial advisors can provide personalized investment advice, tailored to individual goals, risk tolerance, and financial circumstances. A qualified financial advisor can help investors develop a comprehensive financial plan, establish realistic investment objectives, and implement strategies to achieve their goals. Whether it's retirement planning, tax optimization, or wealth preservation, a skilled advisor can offer valuable insights and recommendations to help investors navigate complex financial decisions. When selecting a financial advisor, investors should prioritize credentials, experience, and a fiduciary obligation to act in the client's best interests. It's essential to ask questions, clarify fees and services, and ensure that the advisor's investment philosophy aligns with your objectives. While working with a financial advisor involves costs, the potential benefits, including professional guidance, portfolio diversification, and peace of mind, may outweigh the fees for many investors. Passive investing. Passive investing, often associated with index funds and exchange-traded funds, ETFs, has gained popularity in recent years as a low-cost and efficient way to gain exposure to the stock market. Unlike active investing, which involves frequent buying and selling of securities in an attempt to outperform the market, passive investing seeks to replicate the performance of a specific market index, such as the S&P 500. Passive investors aim to capture the broad market returns over the long term while minimizing costs and avoiding the pitfalls of market timing and stock selection. By investing in diversified index funds or ETFs, investors can achieve instant diversification across a wide range of stocks or bonds with minimal effort and expense. Passive investing offers several advantages, including lower fees, reduced portfolio turnover, and tax efficiency. Additionally, research has shown that passive investment strategies often outperform actively managed funds over the long term, further bolstering the case for a passive approach. While passive investing may not be suitable for every investor or situation, it can serve as a valuable component of a well-diversified investment portfolio. Investors should carefully consider their objectives, risk tolerance, and time horizon before deciding whether passive investing aligns with their financial goals. Navigating the stock market requires a combination of knowledge, discipline, and continuous learning. By understanding key investment principles, staying informed about market trends, and leveraging the expertise of financial professionals, investors can maximize their gains and achieve their financial goals. Whether you're a novice investor or an experienced trader, the stock market offers opportunities for wealth creation and financial independence. By adopting a long-term perspective, maintaining a diversified portfolio, and staying focused on your investment objectives, you can navigate the complexities of the stock market with confidence and success. Remember that investing is a journey, not a destination, and staying committed to your strategy and goals is key to building wealth over time. With the right approach and mindset, you can navigate the stock market effectively and secure a brighter financial future. Thanks for watching. If you found this video helpful, please give it a thumbs up, hit that bell, comment, and subscribe for more content on the International CEO. See you next time.